Something cracked inside the precious metals market today. Not the price chart, not the long-term thesis, not the fundamental case that has been building for 2 years. What cracked was the mechanical structure underneath it, and understanding exactly what broke and why it broke is the difference between panic selling at the worst possible moment and recognizing one of the most precise setups this market has produced in years. Silver just erased more than 8% of its value in a single trading session. Not because the structural supply deficit vanished overnight, not because industrial consumption from solar panel manufacturers suddenly evaporated, not because semiconductor fabrication plants stopped needing silver-based components, not because the defense contractors assembling next-generation weapon systems decided silver was no longer essential. None of that changed. Not a single molecule of physical demand shifted. Silver fell because a class of leveraged traders got margin called simultaneously. And when that happens, brokers do not pause to evaluate your investment thesis. They do not care that silver ran a 4-year supply deficit. They want cash. And to get cash, everything gets sold. Today is Wednesday, March 4th, 2026. Here's exactly where every number that matters sits as this is being recorded. Silver is trading at 80.47, down 8.3% on the session. At the lowest point of the day, it touched $78.90, a decline of more than 10% from yesterday's close. Gold has pulled back to $541, down nearly 4.8% on the day, which by itself is not a small correction for the world's primary monetary metal. Platinum has been absolutely demolished, falling over 11% to trade at $2,064. The S&P 500 is off 2.4%. The dollar index has surged to 98.8, its highest reading in 6 weeks. The 10-year Treasury yield has jumped 8 basis points to sit at 4.14%. And crude oil is screaming higher by more than 9% as the geopolitical situation in the Middle East deteriorates with a speed and severity that is leaving professional traders visibly shaken. Every single one of those numbers is connected, and the way they connect tells you something very precise, not something vague or optimistic by default. Something precise about whether today represents the moment this market has been building toward for the past 18 months. There are 4 forces operating simultaneously right now. The financial media is covering each one in complete isolation. They are reporting the oil spike as an energy story. They are reporting the metal sell-off as a commodities story. They are reporting the dollar surge as a currency story. They are reporting the bond market dysfunction as a rates story. They are wrong to separate them. These are not 4 stories. They are one system responding to one set of inputs. And when you see how the pieces interact, the geopolitical shock, the broken safe haven function of bonds, the unchanged physical deficit in silver, and the mechanical fingerprint of a forced institutional unwind, the picture that emerges is not ambiguous. It is specific and it is tradable. Let us begin with what actually triggered today's move, because most of the coverage has gotten this wrong in a way that fundamentally matters to anyone holding precious metals. Over the weekend, the United States and Israel executed coordinated strikes against Iranian military and nuclear infrastructure. The Strait of Hormuz, through which approximately 21% of global oil supply transits every single day, was effectively shut down by Iranian naval assets in immediate retaliation. The initial reaction across precious metals was exactly what you would expect from 2 centuries of market history. Gold spiked to $420 within hours of the news hitting terminals. Silver surged above $96 for the first time in this cycle. Hard assets behaved precisely the way hard assets are designed to behave when a geopolitical shock of that magnitude lands. Capital flowed immediately into anything that holds value, independent of any single government's creditworthiness. Metals moved exactly as expected. And then something shifted. And this shift is the development that matters infinitely more than the strike itself. Oil kept surging. That was predictable. But the bond market, instead of rallying on safe haven demand the way it has responded to every single major geopolitical crisis in living memory, started selling off. The 10-year Treasury yield did not fall when bombs started dropping. It rose. It moved from 3.91% to above 4.14% in less than 48 hours. That is 8 basis points of upward pressure while military strikes were being executed and shipping lanes were seizing up. If you have tracked markets through even one previous geopolitical shock, you understand how profoundly abnormal that is. Consider the historical record. The Gulf War in 1991 triggered an immediate bond rally as capital fled into the perceived safety of U.S. government debt. September 11, 2001 produced one of the largest single-session bond rallies in recorded history. The Russia-Ukraine escalation in 2022 sent yields sharply lower as institutional capital made the identical flight-to-safety calculation it has always made. Every one of those events, across 3 decades of market history, produced the same response. Yields fell. Bonds absorbed the fear. Treasuries functioned as the world's emergency shelter. That was the established playbook for how professional capital behaves when the world gets dangerous. This time, the playbook failed. And the reason it failed does not just change the picture for bonds, it changes the mathematics for silver in a specific, calculable, and extremely important way. The bond market failed its most fundamental job. And to understand why that failure changes everything for silver, you need to understand what the bond market's safe haven function actually does for the rest of the financial system when it is working correctly. When a geopolitical crisis hits, institutional capital, pension funds, sovereign wealth funds, hedge funds running multi-asset portfolios need somewhere to park. Historically, that somewhere was U.S. Treasuries. Capital flows into bonds, yields fall, and that falling yield environment actually supports risk assets over the medium term because it signals that monetary policy will ease to absorb the shock. It is a self-correcting mechanism. Fear enters the system, bonds absorb it, yields drop, the Federal Reserve has room to respond, and the crisis gets managed through the conventional monetary toolkit. That mechanism is now broken. And it broke for a reason that was entirely predictable to anyone watching the inflation data carefully. The market looked at oil above $84 per barrel, with the Strait of Hormuz functionally closed. It looked at the ISM prices paid index that had already surged to 70.5 in February, before the Iran strike, before the oil shock, before any of this week's developments even existed. That reading represented an 11-point jump in a single month, the fastest acceleration in factory-level input costs that the United States economy has recorded in several years. Manufacturers were already absorbing sharply higher input costs and pricing them into their output before a single missile was fired over the weekend. Now layer an oil shock directly on top of that pre-existing inflationary pressure. The market ran the calculation in real time and reached a conclusion that the bond market's price action confirmed with absolute clarity. This is not simply a geopolitical shock. This is a war-driven inflation shock. One where higher oil prices feed mechanically into higher energy costs, which feed into higher manufacturing costs, which feed into higher goods prices across every sector of the economy that makes, moves, or stores physical things. And if that sequence runs its full course, which becomes more likely with every hour that the strait remains disrupted, the Federal Reserve does not have the ability to cut interest rates into it. It may be forced to do the opposite. That single calculation, the possibility that the Fed stays tight or in an extreme scenario tightens further into a shooting war, is precisely what broke the bond market's safe haven function. When bonds cannot absorb the fear trade, the fear capital has to find somewhere else to go. Right now, it is moving into cash and short-term dollar instruments. That is the mechanical reason the dollar index sits at 98.8 today. The dollar is not surging because the U.S. economy suddenly looks stronger. It is surging because institutional capital is sprinting toward the most liquid instrument it can locate while it calculates what comes next. And in that scramble for immediate liquidity, silver, which carries both significant investment exposure and substantial industrial exposure, got sold alongside everything else in the portfolio. That is the trigger event. But the trigger is not the trade. The trade lives entirely in what the trigger reveals about the current positioning structure. The 8.3% decline in silver today is not a fundamental repricing of what silver is actually worth in a world running a structural supply deficit. It is a mechanical liquidation event. And that distinction is the single most important thing to understand about today's price action. Here is precisely what happened at the position level. The leveraged traders who rode silver from $71 all the way up to $96 over the previous several months are now getting margin called simultaneously. When the S&P 500 drops 2.4% and your silver futures position is bleeding 10% at the exact same moment, your broker does not schedule a meeting to review your long-term investment thesis. They issue a margin call with immediate effect. You post additional collateral within the hour, or they liquidate your position at whatever price the market will accept at that moment. That is forced selling. It has absolutely nothing to do with any investor's conviction about silver's future value. It has everything to do with the arithmetic of leverage colliding with a simultaneous multi-asset drawdown. The fingerprint of that forced unwind is visible in one specific number that tells you more than any price chart can: the gold to silver ratio. As of today's session, that ratio has expanded back to approximately 62.8 to 1. Last week, it was compressing toward 56.5, a 6-point expansion in less than 5 trading days, violent in both speed and absolute magnitude. That ratio movement is not random noise, and it is not ambiguous. When the gold to silver ratio compresses, it means investment demand is flowing into both metals simultaneously, with silver performing alongside gold or actually outpacing it. When the ratio expands violently, as it just did, it means leveraged players are being forced out of silver specifically at a rate that is meaningfully faster than they are being forced out of gold. The ratio expansion is the market leaving a real-time signature in public data. It is communicating directly that this is not conviction selling. This is margin selling. And the difference between those two categories of selling determines everything that happens in the next phase of this market. Conviction selling means the underlying thesis has fundamentally changed. It means sophisticated investors have concluded that silver's actual value is lower than the market previously believed. The supply deficit no longer matters. Industrial demand is structurally softer than the models projected. The case for owning silver has genuinely deteriorated at the root level. When conviction selling drives a price lower, that lower level tends to hold because it reflects a genuine recalibration of real-world value by informed participants. Margin selling means the thesis has not changed. The sellers do not want to sell. They are being forced out by brokers, by risk managers, by portfolio-level deleveraging that has nothing whatsoever to do with silver's actual value in a world of rising industrial demand and multi-year supply deficits. That kind of selling creates a dislocation, a measurable gap between where the market is being forced to trade and where it should trade based on physical reality. And dislocations resolve. The question is never whether they resolve. The question is always the timing and the path. And here is the confirming signal that the thesis remains completely intact, despite today's violent price action. Platinum dropped more than 11% today as well. Platinum carries zero monetary demand. It carries no safe haven characteristics whatsoever. It is a pure industrial metal, and it's sold off harder than gold, a monetary metal, in the middle of a major geopolitical flight to safety event. When every industrial adjacent metal drops harder than gold during what should be a fear-driven flight to safety, that is not a signal about the fundamentals of those metals. That is a signal about leveraged positioning across the entire industrial metals complex being liquidated simultaneously. The selling is mechanical, and mechanical selling is, by definition, finite. It has a beginning, a middle, and an end. The question that every serious participant in this market needs to answer right now is not whether the mechanical selling will end. It will end. Mechanical selling is finite by mathematical definition. There's only so much leveraged positioning to unwind before the forced sellers are gone and the market is left with whoever actually wanted to own the asset at its real fundamental value. The question is where we are in that process. Are we in the middle of the unwind or are we approaching the end of it? And the answer to that question is written in the physical silver market, not in the futures tape. And what the physical market is currently communicating is something that almost nobody covering today's action is paying any attention to whatsoever. Before a single bomb dropped over the weekend, before a single margin call was issued, before the Strait of Hormuz situation escalated into what it has now become, silver was already running a genuine structural supply deficit, not a marginal imbalance that could be absorbed by drawing down existing inventory buffers. A real, multi-year compounding deficit in which industrial demand from solar panel manufacturing, electric vehicle battery production, semiconductor fabrication facilities, and advanced military systems was consuming more silver annually than global mining output and recycling combined were capable of producing. That was the physical reality of the silver market last week. It is still the physical reality of the silver market today. A forced unwind on the futures market does not change how many solar cells China is currently manufacturing. It does not change how many advanced chips TSMC is fabricating at this moment in its facilities across Taiwan and Arizona. It does not change how many next-generation weapon systems require silver-based electrical components to function at the specifications militaries require. The factories are still running. The orders are still in the pipeline. The deficit is still accumulating one day at a time, regardless of what leveraged futures traders are doing with their margin accounts. If anything, the supply reality just deteriorated further, not improved. And here is the specific mechanism by which that deterioration happened. The Strait of Hormuz handles an enormous share of global maritime shipping volume. The disruption to those shipping routes does not exclusively affect oil tankers. It affects every single commodity moving through that corridor. Mining logistics across the broader Middle Eastern and Central Asian region are already facing compounding disruption. Supply chains that were already stretched thin before last weekend are now operating under additional strain from multiple simultaneous directions. The physical tightness in the silver market that was building methodically before this geopolitical event absorbed another significant compressing force over the past 72 hours. The deficit did not shrink because the futures price fell 8%. The deficit widened because the physical supply chain absorbed a new disruption while demand continued running at full industrial capacity. And now layer the inflation signal directly on top of that physical reality. The ISM prices paid index registered 70.5 in February. That reading arrived before the Iran strike, before the oil shock sent energy costs surging, before the Strait of Hormuz situation escalated to its current severity. That number represented inflation reaccelerating at the factory floor level with significant momentum already behind it. Manufacturers were already absorbing sharply higher input costs and pricing them aggressively into their output. Now, an oil shock of potentially historic proportions arrives directly on top of that pre-existing inflationary pressure. The cost environment for industrial manufacturers is not a future concern to model in a spreadsheet. It is a present compounding reality affecting procurement decisions being made today. But here is what the surface-level analysis misses entirely when it looks at higher manufacturing costs and assumes that is negative for silver demand. Higher manufacturing costs do not reduce demand for silver-intensive technologies. In many cases, they structurally increase the urgency of deploying them. Solar panels generate electricity from sunlight at zero marginal fuel cost. In an environment where energy prices are surging precisely because of geopolitical disruption to oil shipping routes, the economic case for deploying silver-intensive solar capacity gets mathematically stronger, not weaker. Every dollar that oil rises above its previous baseline makes the return calculation on solar installation more compelling for every industrial energy consumer on the planet. The same logic applies to efficient circuitry, to advanced power electronics, to any technology category where silver's unmatched electrical conductivity delivers meaningful efficiency gains that directly offset rising energy input costs. So the picture sitting in front of you right now is this. Physical silver is tighter than it was last week. The structural deficit is running faster than it was 7 days ago. The industrial use cases that drive that deficit are becoming more economically compelling as energy costs surge, and the spot price is 8.3% lower than it was at the start of this week. That gap between physical reality and paper price is not a warning signal about silver's fundamental story. It is a precise, factual description of a dislocation created entirely by mechanical futures market dynamics. Now, here's the piece of this story that will matter most 6 months from now. And almost nobody covering today's price action is discussing it because it requires you to look past the futures tape and into the physical market directly. The dealers who track physical silver flow closely, the ones watching actual product movement through wholesale channels, monitoring premium structures on coins and bars, talking to refiners and fabricators about order books, are reporting something that the spot price chart is completely failing to show you. Even as the paper spot price dropped over 8% today, premiums on physical silver are moving higher. The price on the futures tape went down. The price you actually pay to hold physical silver in your hand moved in the opposite direction. That divergence is the physical market, communicating something that the paper market is temporarily distorting. Physical buyers are not retreating from this market on an 8% paper price decline. They are stepping in with increased urgency. The paper sellers are the leveraged longs being forced out by margin calls. Traders who had no intention of ever taking physical delivery, who are simply closing positions to meet immediate cash requirements imposed by their brokers. The physical buyers are the participants who look at an 8% discount on a commodity, running a structural multi-year supply deficit, and start running the arithmetic of what that discount actually represents in real terms when paper price and physical premium move in opposite directions during a sell-off of this magnitude. It is a direct and unambiguous confirmation of the forced unwind thesis. If this were genuine fundamental weakness, if the silver story were actually breaking down at the root level, physical buyers would not be stepping in at rising premiums. They would pull back. They would wait for prices to fall further. They would question the thesis alongside everyone else. They would not absorb inventory at rising premiums while the futures tape is printing new lows. Instead, they are doing exactly the opposite, and that behavior tells you precisely what category of selling today's price action belongs to. The structural deficit is intact. The physical demand is intact. The industrial case is intact and arguably stronger than it was 7 days ago. What is not intact is the leveraged positioning structure that pushed silver from $71 to $96 without the physical market catching up to justify that entire move on a paper basis. That positioning is now being forcibly reset. And when that reset completes, when the last margin call has been met and the last forced seller has been cleared from the market, what remains is the physical reality, and the physical reality has not changed by a single ounce. So where does this leave the actual trade? Where does it leave the person watching silver print 8047 on their screen today after watching it touch $96 less than a week ago? Where does it leave the investor who understands the structural deficit, who understands the geopolitical picture, who understands the difference between conviction selling and margin selling, but who is now sitting in front of a position that is bleeding real money in real time? The answer requires intellectual honesty about three things simultaneously: what the data confirms, what the data does not yet confirm, and what specific triggers would force an abandonment of this thesis entirely. Because intellectual honesty in a week like this is worth more than a clean narrative that makes you feel comfortable while the market does something uncomfortable. Let us start with what the data confirms with high confidence. The forced unwind thesis is confirmed. The gold to silver ratio expanding from 56.5 to 62.8, in 5 trading sessions is not a signal you can dismiss or explain away with alternative interpretations. That is the market leaving a visible mechanical signature in real time. The platinum sell-off exceeding silver's decline during a flight to safety event confirms that industrial metals leverage is being unwound simultaneously across the complex, not selectively. The physical premium divergence, premiums rising while spot price falls, confirms that the selling pressure is entirely contained within the paper futures market and is not being driven by any deterioration in physical demand. Those 3 data points together form a mutually reinforcing picture that points clearly and specifically toward mechanical liquidation rather than fundamental repricing. The structural deficit thesis is confirmed and has actually strengthened. The ISM prices paid at 70.5 before any of this week's events existed. The Strait of Hormuz disruption adding compounding pressure to already strained physical supply chains. Industrial demand running at full capacity across solar, semiconductor, electric vehicle, and defense applications, with no indication of structural softening in any of those categories. The physical reality of the silver market is more constructive today than it was 10 days ago, even as the paper price has moved aggressively in the opposite direction. The bond market dysfunction is confirmed and its implications are significant. U.S. Treasuries failed to perform their safe haven function during an active military conflict involving a major oil-producing region. That failure is not a one-session anomaly. It reflects a structural repricing of U.S. government debt credibility that has been building for months and has now been stress-tested under the most demanding conditions imaginable. When bonds fail as the emergency shelter for institutional capital, that capital needs alternative stores of value over the medium term. The initial move was into cash and short-term dollar instruments because that is where liquidity lives in a crisis. But cash is not a long-term answer in an inflationary environment, and that creates a specific medium-term dynamic for hard assets that the current paper price does not reflect. Now here is what the data does not yet confirm, and this is where precision matters more than confidence. The data does not yet confirm that the forced unwind is complete. Mechanical selling is finite, but it does not announce its own ending in advance. The gold to silver ratio at 62.8 has room to compress back toward 57 or below as the leverage positioning clears. But the timing of that compression is not something any model can predict with precision. It could happen over 3 days. It could take 3 weeks. The physical premium data and the rate of ratio change are the 2 most reliable leading indicators for when the mechanical selling has exhausted itself, and both of those need to be monitored daily rather than assumed. The data does not yet confirm the geopolitical situation has reached its maximum point of escalation. The Strait of Hormuz situation remains fluid with active diplomatic and military developments happening faster than markets can fully price. A further escalation, Iranian mining of the strait, direct confrontation between U.S. naval assets and Iranian forces, secondary sanctions that pull additional major economies into the conflict, would represent a new input that could extend the current volatility beyond what a simple margin call unwind would produce on its own. And now the 3 triggers that would force a fundamental reassessment of the entire thesis. These are not hypothetical concerns raised for the sake of appearing balanced. These are specific, observable, measurable developments that would change the underlying math in ways that matter. Trigger 1, a sustained breakdown in silver's physical premium structure. If physical premiums stop rising and begin declining while spot price continues lower, that would indicate physical buyers are pulling back rather than stepping in. That would convert today's forced unwind narrative into something with genuine fundamental deterioration underneath it. That has not happened as of this recording. If it happens, the thesis changes. Trigger 2, a confirmed demand destruction signal from the solar or semiconductor supply chain. If major solar manufacturers begin announcing order cancellations or production cutbacks specifically citing silver input cost pressures, that would represent a real structural demand signal rather than a temporary paper market dislocation. Watch the earnings guidance from First Solar, from TSMC, from the major EV battery manufacturers over the next 2 reporting cycles. Those companies will tell you directly whether industrial silver demand is softening at the actual procurement level. Trigger 3. Federal Reserve communication that explicitly prioritizes inflation control over financial stability in response to the oil shock. If Fed officials begin signaling that they are prepared to raise rates further into a deteriorating geopolitical environment, the cost of carrying leveraged silver positions rises in a way that extends rather than resolves the current deleveraging cycle. That would not change the physical reality of the market, but it would change the timeline for when paper price reconnects with physical reality in a meaningful way. None of those 3 triggers have fired as of today. The thesis is intact. The dislocation is real and measurable. The physical market is behaving exactly the way it should behave, if today's move is mechanical rather than fundamental. And the 2 lines in the sand that define the outcome from here are simple and specific. A sustained close above $84.50 in silver would confirm the forced unwind is progressing toward completion and the ratio compression is resuming. A breakdown below $76 with declining physical premiums would require an immediate reassessment of everything discussed in this analysis. The silver market did not break today. The mechanics underneath it experienced a violent but temporary disruption. The difference between those two statements is the entire trade. And right now, every data point available, the ratio, the premiums, the physical flow, the deficit trajectory, the unchanged industrial demand, is pointing toward the former rather than the latter. The forced sellers are clearing. The physical buyers are absorbing. And when the last margin call meets the last forced liquidation, what the market finds underneath the paper noise is the same structural story it found before a single bomb dropped over the weekend. Tighter supply, stronger demand. A deficit that does not care what price the futures tape is printing today. That is not optimism by default. That is arithmetic.